Why is US dollar to Japanese yen still rallying despite intervention threats? How to trade yen carry with a 55 ADX trend. US dollar to Japanese yen support and resistance levels for the Asian session. Japanese yen forecast after hitting 40-year low. Best forex trading setups when RSI is overbought but trend is strong. US dollar to Japanese yen breakout prediction and stop-loss placement. Alright, stop what you're doing. I don't care if you're scalping from your phone or managing a 7-figure book. What I'm about to show you on US dollar to Japanese yen right now is a structural anomaly that only appears once every couple of decades. The Japanese yen is hovering at its weakest level in 40 years. That's not a headline, that's a warning shot. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade today. Write them down. They will matter within hours to AT this very moment. US dollar to Japanese yen is printing 161.61. The ADX, that's the average directional index, is sitting at 55.48. If you've traded long enough, you know anything above 40 means the trend is not just strong, it's inescapable. The market is a one-way steamroller right now. The monthly trend, weekly trend, daily, 5-hour, 1-hour, every single chart screams strong buy. But here's where the trap gets laid. The herd is fully invested in the yen collapse narrative. Retail sentiment is overwhelmingly short the yen, long the dollar. Positioning is stretched to the exact kind of extremes where a single headline, one leaked BOJ memo, one Ministry of Finance statement, can trigger a liquidation cascade that wipes out weeks of gains in 6 minutes. And that's the danger zone. The opportunity? The trend itself is your friend until the structure breaks. The entire game today revolves around one number, 160.67. Write this down. If we get a daily close below 160.67, the entire bullish structure resets. That is the invalidation level. Above it, every dip is a potential reload. Below it, the intervention ghost becomes real and the short trade takes control. This number separates winners from account blowers this week. I want you to type 160.67 in the comments right now. Just that number. Let's see how many traders are paying real attention. Now let me walk you down the chart like I'm sitting next to you, because the daily and weekly architecture here tells a story that most chartists completely miss. Pull up your weekly time frame. The 200-week moving average is way down at 156.52. Price is a full 500 pips above it. That's not just a bullish structure, that is a historical dissociation. It tells you the trend has gone parabolic in long-term context. The 50-week moving average at 159.52 is sloping up at an angle that matches the steepest carry trade rallies we saw in 2007 and again in 2014 right before the big tops. On the daily chart, the 20-day MA is at 160.42, the 50-day at 159.52, and the 100-day at 158.48. All rising, all stacked in perfect bullish alignment. Price hasn't touched the 20-day MA in over 7 sessions. That's a runaway market. And when a runaway market finally does mean revert, it doesn't stroll back to the average. It snaps back violently. That's why the sniper entry I'm about to give you is built for that snap. Drop to the 4-hour chart. The 20-period MA is around 160.42, right near the daily MA, a beautiful confluence. The 60-period MA is 159.90, slightly below. The 200-period on the 4-hour is 158.48, same as the daily 100. Every one of these moving averages is a potential support floor if we see a correction. But what most traders miss, and I want you to look at this right now, is the MACD on the 4-hour. It's still printing positive histogram bars, yes, but the signal line has gone flat while price keeps making higher highs. That is a hidden negative divergence in momentum. It's not a sell signal by itself, not even close, but it tells you that every pip higher from here is being bought with less conviction. The fuel is getting thinner. This is the exact setup where a new spike can rip through thin liquidity, Trigger stops above 162.00, and then reverse faster than anyone can click. That's the intervention ghost play. I'll give you the aggressive trade for that in a minute. On the 60-minute chart, we have immediate structure. The pivot point for today's session is 161.53. We are trading just above it. Resistance levels stack like this: 161.99, then 162.39, then the big one, 162.85. Support floors sit at 161.13. Then that critical 160.67, then 160.27. The RSI on the hourlies is at 70.7, stochastic at 73.5, Williams percent R at -13.9. All of them are overbought but not yet turning. In a trend this strong, overbought can stay overbought for days. You don't short overbought in a 55 ADX environment unless you have a very specific trigger. I'll give you one, but you better respect it. Here's the fundamental web that makes this trade infinitely more interesting. The 24-hour news flow is anchored by that headline. Japanese yen hovers at weakest level in 40 years as dollar gains strength. But what's really driving this isn't just dollar strength. It's the yield differential between US 10-year notes and JGBs. That spread is sitting at multi-decade wides. The carry trade is printing money every night you hold it. As long as the Fed stays hawkish and the Bank of Japan drags its feet on rate normalization, the path of least resistance is higher. The BOJ is trapped. They want to support the yen, but every rate hike they deliver threatens their domestic bond market and the government's debt sustainability. So we are in this twilight zone where verbal intervention is cheap and actual intervention is expensive. The Ministry of Finance has the firepower, but they need a catalyst, usually a disorderly, one-way move during thin liquidity. 162.85 is exactly the level where disorderly becomes the description. My 2-week directional lean remains bullish, but with a violent correction alert hanging over. Every extension above 162.40. The event that invalidates the bullish lean entirely is a surprise BOJ rate hike or coordinated jawboning that pushes US dollar to Japanese yen below 160.00 on a closing basis. Until then, we trade the structure. Do you think the dollar breaks 162.85 this week? Comment yes or no right now. I'm tracking Consensus Live. Most people skip this next section. That's exactly where the money is made. Keep watching. I'm going to lay out 3 trade setups, and I want you to screenshot the on-screen trade cards that will appear. These are your plans, not mine. Your execution is everything. Strategy 1 is the sniper, conservative. We are waiting for the snap. I want to see a 1-hour close below 161.30, which means price has lost the pivot and is attacking the first support at 161.13. But I'm not buying the first touch. I need to see a strong rejection wick on the 1-hour candle that bounces from the 161.15 to 161.13 zone. The entry trigger is a 1-hour closeback above 161.45 with bullish engulfing confirmation. Stop loss goes at 160.60, just under S2 at 160.67. That's the structural invalidation. Take profit 1 is 161.99. That's the first resistance. Take profit 2 is 162.39. Risk reward on this setup is 1 to 3.2. This sniper entry is void if the daily candle closes below 160.67 before we even get the trigger. That's the kill switch. Strategy 1, the sniper, entry, 161.45, 1H close above, after bullish rejection from 161.15 zone, stop loss. 160.60 take profit 1, 161.99 take profit 2, 162.39 risk, reward, 1:3.2 invalidation, void if daily close below 160.67. Strategy 2 is the active trader, standard. This one plays the trend continuation without waiting for a deep pullback. We use the 20-period moving average on the 1 hour as our dynamic support. Right now that MA20 is at 160.42, but it's rising. I want to buy limit order at 161.20, which is just above the S1 support and near where the rising MA will be in a few hours. I'll place a stop loss at 160.80, below the round number and below the S1. Take profit 1 is at 161.99. Take profit 2 at 162.40, just above R2. As soon as price hits TP1, move the stop to break even and let the runner ride with a trailing stop of 25 pips. This setup is void if price gaps above 162.00 on the next candle without a pullback. You never chase a breakout in this intervention-sensitive environment. Type your US dollar to Japanese yen range for tomorrow in the comments right now. I want to see who's aligned with the structural levels. Strategy 2, the active trader, hard entry, 161.20, limit order, near rising 1 HMA20 and S1, stop loss, 160.80 take profit 1, 161.99 take profit 2, 162.40, trail stop to break even after TP1 hit, risk, reward, 1:2.4R to TP1, runner open invalidation, void if price opens above 162.00 without retracement. Strategy 3 is the aggressor, high risk. This one is not for the timid. It's a counter-trend scalp that preys on the intervention ghost. I need to see a sharp spike above 162.40 that gets immediately rejected. On the 15-minute chart, a bearish pin bar that pushes back below 162.30 with a 5-minute close under 162.20. Short entry at 162.15, stop loss at 162.55, just above the spike high. Target 1 is 161.50. Target 2 is 161.15. Risk reward is 1 to 3. If the spike doesn't reverse within 3 candles, you cut it. This is a fade against a monster trend. Size down to a quarter of your normal risk. You must be able to lose small. If the BOJ actually steps in, this trade could morph into a 200 pip winner in minutes. But if not, the trend will punish you fast. Only for those who can manage risk aggressively. Strategy 3, the aggressor, high risk entry, 162.15, short, 5-minute close below 162.20 after spike rejection above 162.40, stop loss, 162.55 take profit 1, 161.50 take profit 2, 161.15 risk, reward, 1:3.0 R invalidation, no 5-minute close below 162.20 within 3 candles of the spike risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like the USDJPY or a surprise BOJ announcement. Stops are non-negotiable. This is how you survive to trade the next big move. The yen can gap 80 pips on a Ministry of Finance statement. You do not want to be on the wrong side without a stopped SO. Here's your single most critical level for the next session, 160.67. That is the floor that holds the entire structure together. Above it, the bulls own this market. Below it, the landscape turns into a trap-filled minefield, where every bounce is sold. Tomorrow's wildcard is the Tokyo fixing and any unscheduled BOJ commentary. If the fix shows unusual demand for yen, or if a finance ministry official uses the phrase decisive action, the aggressive trade activates instantly. I'll be covering that live in the next video. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. The next 48 hours in yen are going to be unforgettable. Don't trade them blind.